This screencast is looking at the January 2016 question 2, GreenCo, focused on CVP analysis. So again, we'll just look through the requirements first. So there's a couple of multiple requirements. This is typical of a CVP type question. Whereas firstly, determine the selling price per unit, variable cost and contribution per unit for lean green based on the budget provided. So that's 8 marks. B, 1 and 2 are kind of linked. You're asked to calculate the break-even point, assuming they continue to avail of Selco services and the margin of safety. Right. And assuming then they decide to bring the sales and marketing function in-house, you're asked for the break-even, the margin of safety, and 2 or 3 other calculations. So again, you have kind of 2 different scenarios there. The status quo, where they continue to pay commission to Selco, and if they change it or bring it in-house. So a very topical and common issue that you might arise in certain organizations. And finally, then part D is linked again. 20 marks, more narrative discussion about operating leverage, and particularly part 2 then is applying your knowledge of operating leverage or operational gearing to the particular company. So again, you can see the first part of it for about 40 marks is around the calculations, and the last part then is around narrative and applying your knowledge to the particular facts of the case. So have a read through the question, and in particular the numbers. So the background of this company is it's a distributor of garden fertilizer, and we're looking at one particular product, GreenCo, that has grown significantly over the last 3 years. So how it works is they sell it. The Selco is a kind of sales and marketing company or distributor that they pay a 10% commission to based on revenue to provide that service. So you're given the budget for 2016, and you're told they currently think that the 10% commission is excessive, and they're thinking about bringing it in-house. And you're given information then about the amount of reps they'll need, the sales commission they'll have to pay the reps, and any other associated admin costs. But we'll deal with that in part C when we look at changing the status quo. So a starting point of the question is calculate the selling price per unit, variable cost and contribution per unit. So we go up to the table, we're given sales for the year, we're given cost of goods sold, and we're given other selling costs. And we're also told in note 1 that the sales is based on 100,000 units, and you're told that GreenCo show their revenue on a net basis, i.e. that includes the commission fee. So that is important. That was a kind of little exam trick to put in to see where students paying attention. So your net sales, if we look at it, just increase this a small bit, your net sales is 900,000. Okay, but remember that represents 90% of gross sales. And if we want the selling price per unit, because we may change the commission model in the future, so we need the full price per unit, we need to get the gross sales. So gross sales, we need to figure out before commission. So if we know these are 90% of sales, what you can do is 900,000 divided by 90 times 100 to bring it back to the gross sales, i.e. before commission is taken off, is, and we'll just change that to put in looking a bit better, 1 million, and your commission, which is 10%, will be of course 100,000. So that was one of the tricks you needed to watch there, that when I asked for selling price per unit, we wanted the before the commission, because commission is really a variable cost. It's not actually as part of the selling price. Particularly when we change the model for part C, we can't just use 900,000 as the assumed sales, because that includes the commission, which we may be removing. So it's important to pay attention to ask yourself, why am I told that? So the selling price per unit, so the sales price per unit, is 1 million divided by 100,000, because it's 100,000 units assumed in this volume. So selling price per unit is 10. The variable costs we need to list out. So our variable costs are ones that move in line with activity. So we assume direct materials will be variable, and direct labour is usually variable as well. Fixed manufacturing costs would not be. Fixed distribution wouldn't be, but you would have variable distribution costs. And the other one, not to forget it, is your commission. That is a variable cost, because the more sales you make, the more commission you pay as well. So don't forget it should be in its cost, not netted off in the revenue. So total direct materials, put that over there per unit. Total direct materials, 300,000. Total direct labour, 150. Again, unless told otherwise, we usually in the question assume they are variable costs. So unless you're told it's a mixed cost or a fixed cost, anything that says direct materials or direct labour, their usual assumption is that it's variable. It moves up and down with the number of units you sell of the fertiliser. Variable distribution costs are 60, and the commission we know is 100,000, as we've calculated already up here. So the total of those is 610,000, and we want the variable cost per unit. So you divide by the number of units in the budget, which is, in this case, 100,000. So the total variable cost per unit is 6.1. So it's €3 per unit for materials, €1.50 for labour, 60 cent for variable distribution costs, and again, €1 per unit for commission. So in total then, it's 6.1 for variable costs, and we know our contribution per unit, our CPU as we call it, is sales price minus variable costs. So our selling price, which is 10, minus our variable costs, which is 6.1. So what that means is, for every extra unit of GreenCo you sell, you're generating €3.90 in profit. That can be contributed to cover your fixed costs. So contribution is €3.90 per unit. And that is important to calculate your break even. So the only thing to watch out there was you needed to show sales, the total sales, as opposed to net of commission. The commission is a variable cost, and it's important we keep that separate, particularly when we start looking at the alternative marketing structure. And we'll see that as we come to part C. So that is our part A. Our part B then asks us, assuming we continue with the current status quo, calculate the break-even point in units and sales revenue. So remember, while we get the break-even, so our B, the break-even equals your fixed costs over your CPU. So we need to cover our fixed costs before we break even. So we need to cover them before we start making a profit. And our fixed costs are made up of, if we look up here, 3 elements. Fixed manufacturing, so I'll write it in here. So manufacturing, distribution, and admin. 3 elements of fixed cost, which are 50,000, 70,000, and another 50 for admin. So the total fixed costs are 170,000. So the way you have to think about to break even, we need to generate 170 from sales, i.e. contribution, before we even start to make a profit. We need to cover that to cover our losses. So the break even then, in units, will be 170,000 divided by 3.9, which is the contribution per unit. So the break even there, if we round it, is about 43,590. So we need to sell 43,590 units just to break even. Because if we sell 43,590 times 3.9 gets us 170,000, which just covers all the fixed costs we have. So we don't make a loss, nor do we make a profit. We just break even to cover everything. So that's what the break even amount is. That's it in units, but we also need it in revenue. So in terms of euros, if we sell 43,590 units, you multiply that by €10, that's the amount of revenue, 435,897. So it's just slightly different because it's rounded. So in Excel it shows rounding, so just a slight difference. But you won't be marked down if you're out by a couple of euro, as long as it can see where you've rounded from. So if we make sales of 435, so that's, we'll say here revenue is 435,897. And just to prove that it is break even, we can calculate our variable costs in euro. Our variable cost will be the number of units times 6.1. So our variable cost there are 265,897, giving us a contribution. So this is, you don't need to do this, but it's just to prove that this is the break-even amount. Contribution is our total revenue minus our total variable costs, which was 170. You take off your fixed costs, which are 170 as well, giving you a profit then of 0. So that proves in our case that at 43,590, that is the break-even point, where you don't make a loss, nor do you make a profit. The other element related to break-even is your margin of safety. And what this tells us is the buffer we have between what our expected sales are, expected or budgeted is 100,000, and the break-even. The break-even here is 43,590. So we want to figure out how much can sales fall from the expected level before we are loss-making, before we hit the break-even amount. And how we calculate that is we look at the difference between expected, put in brackets, expected minus your break-even over the expected. So by what percentage can revenue fall in terms of units before we hit the break-even point? It can fall by about 56%, which is easy to understand in this case because if it falls by about 56,000 units, that's when you hit your break-even. So the margin of safety in percentage terms is 56%. The margin of safety in units, it can fall from 100,000 down to 43. So that's it in units. So it's easier to understand when it's in round figures like 1,000. It can fall by 56,000 units before your break-even. So you have a significant margin of safety there. You're not under threat of having a major issue with loss-making product because there's such a low break-even relative to the expected level of sales. So that's your part B. So you have 8 and 8 is 16 marks already under your belt. So if you have practiced it, there will be a cohort of requirements that you'll be able to easily pick up marks if you've practiced the past questions. So the next one, part C, is looking at a slightly different alternative where we're looking at changing the sales function. So instead of doing Salesco's services, or Selco should I say, we're going to bring it in-house. So if we bring it in-house, what we're doing is we're getting rid of the commission. We're telling it's excessive. We're going to hire 3 sales reps at a base salary of 30,000 each. That's a fixed cost of 90,000, 3 times 30. And we're also going to offer a 4% sales commission. Again, just to ensure we get motivated salespeople. So that's a variable cost. And finally, the fixed distribution costs are going up by 20% because we've more related admin expenses and distribution expenses because we're bringing it in-house. So it's not an unusual scenario where companies not happy with the distributor they're using, perhaps in a new market, and they're looking about setting up a sales team. You're essentially changing there from a variable cost to a predominantly fixed cost. So we now need to calculate the break-even point and the margin of safety and comment on your findings. So essentially we're doing part B again, but for a different setup. So selling price is still €10 a unit. Our variable costs now are going to change. Right, so we still have direct materials, we still have direct labour. If we go back up, we still have both of those, direct materials, direct labour. We still have variable distribution costs. So we call it variable distribution. And we also have a commission, although it's going to be smaller. Right, but we need to redo the contribution per unit because the cost structure has changed. So our variable costs here, our direct materials are still €3 a unit. It's 300,000 for 100,000 units, so that's €3 a unit. Direct labour is still 150, and variable distribution costs haven't changed either. So all of those are 150, and this is 60 cents. So those haven't changed. Commission has changed. It's now 4% of revenue, so 0.04. So it's 40 cents. Right, so it's 4% of revenue. It used to be 10%, but we've changed it now. So the total variable cost then is now 5.5. It used to be, under the old one, 6.1, but we've dropped it down. So it's now 5.5. Just put a border there, just to make it easier to understand. That means our new contribution per unit is 10 minus 5.5. So under the new structure, our contribution per unit is €4.50. That is higher than before by 60 cents because we have less variable costs. So we've removed some variable costs, but our fixed costs, the original fixed costs of 170 remain. So they're still going to be there. But we now have 3 reps, which are going to cost 90,000 of a base salary, because you have 3 reps at 30,000 each, and you also have extra distribution costs, which are told there fixed distribution costs are going to increase by 20%. Distribution costs currently are at 70%, so they're going to go up by a fifth. So 70,000 times 0.2, another 14. So although we benefit from lower variable costs, we now have higher fixed costs. They're up to 274,000. So what we can see there is we're benefiting by lower variable, but our fixed costs are going up by 104,000. So we're compensating one cost for another. We're changing our cost structure. And what you're asked in part C is, how does that change our key metrics? How does it change our break even? Well, our break even now in units is 274 over 450. So our break even now is 60,000 units, just over 60,000. And in euros of revenue, it's 60,000 times 10, which of course is the selling price per unit. So the break even has now increased. Before, the break even was only 43,500. Now it's gone up to 60,889. And that's because the higher you have fixed costs in a business, the higher the level of break even. Right? So you need a high level of volume before you even break even. But after that, then it's very profitable. So you have a high threshold to reach, but after that, every extra sale you make is very profitable because you have lower variable costs. The other question as part of B1 is the margin of safety. Margin of safety in units is 100,000, which is the expected sales, minus the break even. Or you can get the margin of safety in percentage terms. So write the units there. So we're asking ourselves, well, the percentage is the current expected level of sales, 100,000, minus the break even over the expected level of sales. That's a formula you need to know, and somewhat intuitive in terms of how much can sales fall, should I say, in the percentage before you reach break even. And in this case, they can fall 39%. It's just somewhat intuitive here because we happen to have it as a nice round 100,000 base. It can fall 39% before you break even. So the margin of safety has fallen, which of course it has because the break even is increased. So you have a less of a buffer before you fall to break even. So that's a useful one to understand. So you have to risk your position because you have more fixed costs in your cost base. The next one is asking you, and again an intuitive type question, part 2, determine the level of sales in units that GreenCo would need to make to ensure budgeted profit of 220. And where's the 220? Well, we're saying in the current setup, we can make 220,000 profit if we sell 100,000 units. However, the target profit is 220. So how we do the target profit calculation is very similar to break even. We add it on to the fixed costs. So fixed costs are 274. So we say now the target is 494. So if we want to cover fixed costs and we want to cover a budgeted profit, which is after we meet our fixed costs, we need to cover 494. So the target units to sell are 494, very similar formula to break even, over the contribution per unit, which is €4.50. Which we need to sell 109,000 units to make 220,000 profit. So we can see now in the new setup where we bring the sales in-house, we need to sell about nearly 10,000 units more just to make the same level of profit. So financially, we are worse off. Now, there could be strategic issues we'll talk about in part D, but here from a financial perspective, just to meet the same level of budgeted profit, if we change the cost structure, we have to make nearly 9,000 or 9,800 nearly extra unit sales just to stand still. So it's a useful insight to have as a manager. And again, just to prove that, if we do our revenue, we do our variable costs, and we do our fixed costs, just to prove that we're correct in our calculations, if we sell 109,788 units, well, that's going to be 109 times 10. That's our revenue, because the selling price per unit is still 10. So we're just proving this. You don't need to do it, but it's useful to prove, is the actual budgeted profit coming to 220? Our variable costs per unit will be 109,000 units times 550, because that's where we've totted up. Each unit, no matter how many units you do, are going to cost €5.50 when all the variable costs are in there. So that's going to be about 600,000 euro. So that gives us a contribution of 494, which you'll notice is a familiar figure from before. And if we take off our fixed cost of 274, give us a profit of 220. So you can see the logic of, essentially, contribution must cover the desired profit plus the fixed costs. And that's why we add them together to figure out the target units. So it's always useful, particularly when you're studying early on, work back to prove that your calculation works. The figure that you get for break-even, does it give you the break-even as zero profit? Just prove it. Does it give you the target profit? So it's no harm proving it. You don't have to do it in the exam, but it's a good sense check, particularly when you're learning it early on. Alright, so that's getting a bit trickier as an example. Now here, and you'll expect to see some of these in exams. This is what I call the first class requirement. Not every student will get it, only a minority, but I bring in some elements to see, for the very good students, are they thinking about how you might determine certain elements, and they're really thinking in depth about what the figures are telling us. So this question, it's a common enough one in terms of managers. They want to know at what level of sales will profits be the same for both alternatives. So at what level of sales do you need to reach before you're indifferent? So it currently looks at now that at the current level of sales, at around 100,000, the current structure is more attractive because we're more profitable at 100,000 units than we would be if we did this. Because of more fixed costs, it's not as attractive. So it currently looks like at low volumes, the commission seems to be worthwhile, which makes sense because you need high volumes to cover all those fixed costs of the reps. And what we want to know is, where's the turning point? At what level of volume does it justify financially bringing on all these reps? So again, it's a very practical requirement. How you go about it is a bit tricky. So how we need to look at this then is we look at the existing structure where the contribution per unit is €3.90 and the fixed costs are 170. And we compare that to the contribution per unit proposed, which is 450, but the fixed costs are 274. And what we try and think about here is, right, at what level will these two equal? Right, so if we think about it currently, how we get the profit for any combination of those, the profit equals the volume times CPU minus the fixed costs. Because that's how we get your profit. You get your volume times the contribution per unit and you take off your fixed costs. So if we look at a volume of 100,000 units for both of these. So at a volume of 100,000 units, and this is a useful way of looking at it, the profit here is going to be €3.90 times 100,000 minus 170. So that's what the profit is going to be, which is the 220. And again, we've calculated and proved that up here, that at 100,000 units, that's what the budgeted profit is. So it's just a shorter way of presenting it. However, in the proposed structure, if we look at 100,000 units, it's 100,000 times 450 minus 274. So it's actually less attractive because we've so much fixed costs, we need higher volume to justify them. So let's, for example, we'll go to 250,000 units. Now it might be unrealistic, but we'll just have an example and see. So what would the profit be in the existing structure at 250? Well, it's 250,000 units times 390, because remember that's the variable amount, selling price minus variable costs, minus the 170, which doesn't change because it's fixed. It doesn't change with the level of activity. So there your profit is 805, whereas here for 250,000 units, times 450, minus 274, it's 851. So what we can actually see here is, at some stage between 100 and 250, the proposed cost structure is more attractive, because the bigger volume, it's been covered in the sales reps, and for every extra unit you sell now, it's more profitable. So what you're asked to do is, at what point is the tipping point? Where does it become more attractive for the proposed structure than the original one? And one useful way of thinking about it is, you're swapping an extra 104,000 fixed costs. So 104,000 extra fixed costs. That's what you have there. In return for getting an extra 60 cent per unit. That's the way you have to look at it. So you get an extra 60 cent per unit, but you have to cover an extra 104,000 costs. So just to cover those extra costs, you'd have to sell 104,000 divided by 0.6. So you have to sell 173,333 units is where both of them are the exact same. Now there are other ways of going about it, and that's fine if you get to it. I'm not overly concerned about it, but I want you to think about, well, what's the main incremental difference here? If I go the proposed structure, I get an extra 60 cent per unit, because they're lower variable costs, but I first need to cover an extra 104,000 costs. So that means I need to get to 173 before I even have covered the extra costs. So once I cover them, after that, it's more profitable. I said, don't tie yourself up too much. If I prove that just for the sake of it, so I'll just bring this a bit bigger. At 173,333, the profit here would be 173,333 times 3.9 minus 170. So about 505,999. Now there's going to be a small bit of rounding here. And in the proposed structure, if I have 173,000 units, 333 times 450 minus 274, it's 505,999. And that's the question you're asked is, at what level are they equal? They're equal at around 173,000 units. Below that, the existing structure is more likely because it's a nicer variable cost element. But when you get to higher volumes, you can justify the fixed costs, and therefore you go for the proposed structure, bringing it in-house. So again, very common, very commercial type of analysis where you're trying to think about what level do I need to justify this? What level do I need a sales to justify sales reps? So it's a very commercial way of thinking about things where accounting information and particularly CVP concepts can be very helpful. So lastly then, we have the narrative element. So I'll let you have a look at that yourself. But what you're saying is explaining operating leverage, which essentially is the element of fixed costs versus variable costs in the organization. And in particular here in the context of GreenCo, discuss the impact. Well, the impact this is having is it's reducing variable costs and increasing fixed costs. So it's increasing the operational leverage, also known as the operational gearing in the company. So that is increasing the risk because we now have a lot more fixed costs. And as we've seen already, that means a higher break even. So it's important you just understand that by bringing sales reps in, they have a fixed amount of salary. So regardless of whether they sell or not, they're going to be paid 30 grand each. So that brings an element of risk. If the sales fall, you're going to have that fixed cost on your books. And the final thing you can see where I've underlined, three other factors. So as long as they're applied to the facts of the case, the strategic value of having marketing in-house, your future plans about growth, where you might want to have people in-house, or the ability to negotiate down the 10% instead of doing a drastic change in-house. You may first protocol maybe negotiating the commission as opposed to making the big change first. But as I said, as long as they're applied to the facts of the case, you'll get your credit. So overall, that was an exam standard question in CVP analysis from January 2016.